Welcome to FinBytes. Hi everyone, we will be starting a brand new series on basic concepts of stock market. Today's topic will be on what is a stock split. Before learning about stock split, we need to understand another important term, which is the face value of the share. So, what is a face value of a share? Let's assume a group of friends decides to start a new company. Each of them invests their money into the company and in return will receive equivalent worth of shares. These friends will be termed as promoters of the company. The price in the share certificate at which these shares were offered for the promoters is known as the face value of the share. So in simple terms, whatever is the price written in the share certificate will be termed as face value of that particular share. I hope the concept of face value is clear. Now, one of the promoter wants to sell his shares in the open market. There will be three possible scenarios. So let's consider that the face value of the share is 10 rupees. In the first case, he will be selling his shares at rupees 20. He will be making a profit of 10 rupees. Hence, we can say that the shares are trading at a premium. In the second scenario, he sells his shares at 10 rupees. Basically, there is no loss or no profit. Hence, we can say that the shares are trading at par. In the third scenario, he sells his shares at 5 rupees. He is making a loss of 5 rupees. Hence, we can say that the shares are trading at a discount. The same concept holds very much true for the bond markets as well. With this concept in mind, let's check out what is a stock split. Below is the definition for stock split from Investopedia. It states like, a stock split is when a company divides the existing shares of its stocks into multiple new shares to boost the stock's liquidity. Although the number of shares outstanding increases by a specific multiple, the total dollar value of the shares remain the same compared to the pre-split amounts because the split doesn't add any real value. Let's consider this and understand in a much more simpler terms. Consider a share of a company A is trading at 10,000 rupees in the market whose face value is 10 rupees. As a retailer, there will be very much less trading or investing activities in this share due to its higher price. When there is less trading or investing activities, we call this share to be illiquid or less liquid, as there will be very few people who will be willing to buy or sell, and it's quite hard to receive the price we are looking for. To boost liquidity, company will reduce the market price by splitting its shares. A split of 1:10 meaning 1 shares gets splitted into 10 shares. Accordingly, the face value of the share will change from rupees 10 to rupees 1 and the market price will be reduced from 10,000 rupees to 1,000 rupees. Doing this, the number of outstanding shares will increase, the price of the stock will decrease, and the value of the invested amount will be intact. When price decreases, more people will show interest in the stock and liquidity increases. To visualize this concept, let's have a look at an example. Let's consider two scenarios. Firstly, before split. Company ABC, whose face value is 10 and the market price which is trading at 10,000 rupees. And we are holding 10 shares. So total value invested in this share would be the quantity we are holding, which is 10, multiplied by its current market price, which is 10,000, resulting in an invested amount of 1 lakh rupees. So in the second scenario, which is the after split, the same company face value will be reduced to 1, market price will be reduced to 1,000 rupees, and we will be holding 100 shares instead of 10 shares. So total value will be total number of shares we are holding, which is 100, multiplied by the current market price, which is 1,000, and this results in an invested amount of again 1 lakh rupees. So summarizing the overall concept, when a split occurs, there will be the following outcomes. The face value of the share will be reduced, market price will be reduced, number of shares increases, and the invested amount will be intact. I hope the concept of face value and split is clear. Subscribe to our channel to break down complicated financial concepts. Thank you.